Would you like to learn a great way to use the butterfly spread? Hi, I'm Larry Gaines, PowerCycleTrading.com, and in this video I'm going to show you how to incorporate an option butterfly spread and a bear call credit spread together to trade what we call option expiration. So here's Apple. You can see Apple here is trading down right now. It's trading at about 158, 159, call it. So what we're looking for is a setup where for monthly option expiration we can look at a potential for Apple to go out at the $160 strike. Now, the $160 strike has a lot of unusual option activity, so it gives it a target for potential price action to that 160 strike. So you can see right now it's currently about $1 below. So one trade setup where you can put on a trade to take advantage of if Apple was to push back up to the 160 is to do what we call a call butterfly, and then you add a bear call credit spread to it. So it becomes what we call a call ratio butterfly. So here's what it looks like. So the initial setup was to establish a expiration trade for the September 15 series. So looking for a push to 160 into expiration. So wanted to do a very low risk trade in case it didn't push into 160, so you don't have much capital to potentially exposure to the downside. So the initial trade was buying the 157.5 call, selling the 160, then buying the 162.5. So this is what we call a balanced butterfly. It's $2.50 wide spread. When it was put on for 79 cents. So $79 to the downside is your max risk, 79 to the upside is your max risk. And the max profit is if it goes out at 160, you make over 170. Now to reduce the risk of this trade, so what we did in order to reduce it, since Apple looked like it could potentially go lower, and it did, we sold a bear call credit spread, an additional leg, selling the 160, buying the 162.5. So that's a bear call credit spread, brought in 64 cents credit. So you can see the risk profile right now then is only a maximum if Apple was to collapse down to the downside. The maximum at risk would be $15. If it goes up to 160, you still make you make over $200. Fantastic return. And the biggest risk is then back to the upside. So a really unique structure for trading what we call an option expiration, or trading a target trade to a specific target, and in this example to 160 with a good downside protection using that additional bear call credit spread. Hope this helps. Talk to you on my next video update.